Welcome to The Explainer, where we break down the big stories. And wow, what a day it was today, January 30th, 2026. We saw this incredible split in the Asian markets, a day of historic, record-breaking highs right alongside some really sharp drops. We're going to unpack exactly what happened and why. Here's what we're going to cover. First, we'll look at this dramatic split we saw today. Then we'll dig into the reasons behind it all. After that, we'll project what might be coming next month, explore a few strategies the pros might be using, and then wrap it all up with the most important takeaways for you. All right, first up, let's just look at how this truly historic day unfolded, because it really did reveal a market with two completely different faces. The big headline of the day, no question, was the Korean Kospi Index. I mean, it absolutely shattered records, surging past 5,300 for the first time in its history. This was a really monumental moment for the market. But here's where things get really interesting. That record-breaking momentum, it just didn't hold. The KSP ended the day almost flat. And at the same time, Korea's tech-heavy KSQ 150 and Hong Kong's Hang Seng Index were telling a totally different story, both dropping over 2%. A huge contrast.
And this table just lays it all out, doesn't it? You can see a sea of red across China and Hong Kong, standing in stark contrast to that record-setting day in Korea's main index. So what on earth caused this massive divide?
Okay, so let's get into the why. Let's explore the powerful forces, both economic and, psychological, that were pushing and pulling these markets in completely opposite directions. To really get what happened in Korea, it helps to look at this theory from an economist named Gunter Duke. It's called collective enthusiasm. The basic idea is that sometimes markets are moved less by cold, hard logic and more by, group emotion and intuition. He's basically saying that mass psychology can just take over, pushing a market way higher than the numbers alone might suggest is reasonable. And in this case, it seems like a huge wave of optimism took hold, all centered around this big idea of a semiconductor supercycle. This belief in a long period of soaring demand for computer chips. And get this, the data totally backs it up. Individual investors, we're talking regular people, poured a staggering 2.29 trillion won into the Korean market just today. That's what was fueling that record-breaking surge. It was pure, unadulterated optimism. So while Korea was riding this incredible wave of local optimism, the story playing out in China and Hong Kong could not have been more different. Over there, the key driver was the exact opposite force. Institutional uncertainty. This is what happens when investors feel like the rules of the game are unstable or just unpredictable. And when that happens, confidence just vanishes. And this really highlights the perfect storm that hit those markets. You had a combination of stalled trade talks with the US and new domestic crackdowns on trading. That created this huge wave of uncertainty, which spooked investors and triggered a major sell-off. Okay, so now that we have a pretty good idea of the why behind today's wild action, let's look ahead. What does the data suggest might be coming our way in February? Well, the economic models are pretty much all screaming one thing: volatility. You can see just how wide the forecast ranges are for all these indexes. Take the KOSPI, for instance. The forecast shows a potential swing between 4,900 and 5,550. That is a significant range of motion. This slide really boils the whole forecast down to a massive tug-of-war. On one side, you've got these powerful forces pushing markets up, like strong corporate earnings. But on the other side, you have these major political and trade risks that are pulling them right back down. Now, here is a really key warning sign, especially for the Korean market. It's called the Relative Strength Index, or RSI. Think of it like a speedometer for market momentum, and right now it's at 79.2. Anything above 70 is considered overbought, which is basically a signal that this recent rally might be overheated and could be due for a cool down. So you've got a market that's both running hot and facing some major risks. This kind of complexity is exactly where professional quantitative traders start to look for opportunities. Now, just as a quick note, what we're about to discuss is just an explanation of some potential strategies. It is not financial advice. So one approach is something called a pair trade. This is a market-neutral strategy, which means it isn't a bet on whether the whole market is going to go up or down. Instead, it's a bet that this unusually wide performance gap we're seeing between the overbought Kospi and the underperforming Kosdaq will eventually narrow and get back to normal. Okay, a more advanced strategy involves betting that the market will simply calm down.
By selling options in a structure called a short straddle, a trader collects money up front. Then, if volatility goes down, like some statistical models predict, those options lose value and the trader profits. But, and this is a big but, it's a high-risk play if some surprise news event causes volatility to spike instead.
And then there's a third, totally different kind of strategy. This one is event-driven, and it focuses on just one company, Baidu. Here, the bet is on a specific potential corporate event, spinning off its AI chip unit that could unlock a ton of hidden value for its shareholders. Okay, we've gone through a lot of complex analysis. So let's just distill all of it down into a few clear, crucial points that you can take away from today's action. Here's probably the simplest way to think about what happened today. Korea's big stocks were having a party, all thanks to that semiconductor boom. But that party is showing signs of getting tired. At the same time, China and Hong Kong are really feeling the pressure from politics and new regulations. So what's the ultimate takeaway here? I think it can be summed up with this really powerful metaphor from market analyst Ken Fisher. He says, now is the time to enjoy the magnificent dance, but stand closest to the exit before the music stops. It's just a great reminder to appreciate the market's current strength, but to always, always stay vigilant for when that music inevitably changes. The question isn't if, but when.